Let's start with the basics. The warning signs are everywhere. Inflation, once called transitory, has mutated into a structural problem. Governments around the world printed trillions during the pandemic, creating an artificial bubble of demand that fueled record profits for corporations and speculative mania in every asset class. Now that liquidity has evaporated, central banks, led by the Federal Reserve, have been forced to slam on the brakes with the fastest interest rate hikes in modern history. And the result? Credit is drying up. Borrowing costs are crushing businesses and consumers alike. The U.S. national debt just passed 35 trillion, and interest payments alone are now greater than the defense budget. Think about that. America is paying more just to service its debt than to protect its borders. That's unsustainable, and markets know it. The stock market, which has enjoyed one of the longest bull runs in history, is showing clear signs of exhaustion. The so-called Magnificent Seven, Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, have carried the entire market on their backs. But behind those flashy numbers, over 70% of stocks in the S&P 500 have either stagnated or declined this year. That means the foundation is already weak. The illusion of strength comes from a handful of mega caps propped up by hype and buybacks. And when investor sentiment shifts, those same giants could fall the hardest. Remember what happened to Lehman Brothers? It only took one domino to fall before the entire global system started collapsing. This time, that domino could be a major tech stock, a collapsing bond market, or even a sovereign debt crisis. Speaking of bonds, this is where the real danger lies. In 2008, the crash was caused by supreme mortgages and reckless lending. But this time, it's the bond market that could ignite the explosion. The global bond market is worth over 130 trillion, and yields have spiked to levels not seen in decades. That means bond prices have collapsed, wiping out trillions in paper wealth. Pension funds, banks, and governments all rely on stable bond markets. If yields continue to rise, their portfolios implode. We already saw a taste of this in 2022 when the UK's pension system nearly collapsed because of leveraged bets on bonds. The Bank of England had to step in and bail them out quietly. That same stress is now brewing globally, and central banks can't print their way out without reigniting inflation. Now, let's talk about real estate, another ticking time bomb. The housing market is frozen. Mortgage rates are hovering near 8%, the highest in over 2 decades. Buyers can't afford new homes, and sellers refuse to drop prices. That's a stalemate, and when it breaks, it's going to be brutal. Commercial real estate, in particular, is a disaster in slow motion. Office buildings in major cities like New York, San Francisco, and London are half empty, yet still valued as if they're full. Remote work has permanently changed the landscape, but valuations haven't adjusted. A massive wave of refinancing is coming, and those loans were issued at near zero interest rates. Now, they must be rolled over at triple the cost. Many landlords simply won't survive that math. Banks with heavy exposure to commercial real estate are already sweating bullets, and if a few major defaults hit, we could see a contagion event ripple through the financial system. Then there's the elephant in the room: government debt. The U.S. Treasury has to constantly issue new bonds to finance the deficit, but foreign buyers are stepping back. China and Japan, once massive holders of U.S. debt, are selling off. That means domestic institutions must absorb the difference, but they're already overloaded. As yields rise, the government's interest payments balloon, creating a vicious cycle of debt issuance just to pay off old interest. At some point, investors lose confidence, and when confidence dies, currencies collapse. That's the nightmare scenario, a loss of faith in fiat money itself. Central banks will then have to choose between saving the bond market or saving the currency. They can't do both. If they print money again to bail out the system, inflation will skyrocket. If they refuse, markets will crash. Either path leads to pain. This brings us to the next major trigger: the derivatives market. It's the dark underbelly of modern finance, often ignored by mainstream media because it's too complex. But here's what you need to know: the global derivatives market is estimated at over 600 trillion. That's more than 6 times the world's GDP. These financial instruments are built on leverage, speculation, and counterparty trust. In a stable system, they function smoothly. But in a volatile system like the one we're entering, they become weapons of mass destruction. A single default can trigger a chain reaction that cascades through the entire network. It's exactly what happened in 2008 when AIGS derivatives exposure brought down the global economy. The difference today is scale. Everything is bigger, faster, and more interconnected. With AI-driven trading algorithms executing billions in milliseconds, any panic could turn into a meltdown before human intervention is even possible. And don't think crypto will escape this chaos. Yes, Bitcoin and other digital assets were created as a hedge against the failures of the traditional financial system, but let's be honest, when liquidity dries up, everything sells off. In a major crash, investors run to cash, not risk. Bitcoin could see another massive correction before the dust settles. However, in the long run, this crisis might be the ultimate catalyst for crypto adoption. Because when governments start debasing their currencies again, people will look for hard, decentralized alternatives. But in the short term, volatility will be extreme. Altcoins, memcoins, and over-leveraged DeFi projects could vanish overnight. Now, let's discuss the psychological component: investor complacency. Markets don't crash when everyone is scared, they crash when everyone is comfortable. Right now, retail traders are flooding back in, convinced the worst is over. Meme stocks are pumping again, crypto Twitter is euphoric, and the average investor believes the Fed will somehow engineer a soft landing. But history shows that soft landings are a fantasy. Every tightening cycle in modern history has ended in recession, every single one. The timing varies, but the outcome is consistent. And this time, the system is more fragile than ever because it's built on leverage and illusion. We've replaced productivity with speculation, savings with credit, and innovation with manipulation. Corporate America is also masking reality. Record stock buybacks and accounting tricks are creating the illusion of profitability. Meanwhile, real earnings growth is slowing, layoffs are rising, and consumer debt is exploding. Credit card delinquencies are at their highest since 2011, auto loan defaults are climbing, and personal savings rates have collapsed to near record lows. The average household is financially exhausted, living paycheck to paycheck while inflation quietly erodes purchasing power. The middle class, the backbone of any stable economy, is being hollowed out. When the next shock hits, millions won't have a safety net. That's how recessions turn into depressions. And speaking of safety nets, banks are not nearly as stable as they appear. Remember the regional banking crisis of 2023? Silicon Valley Bank, Signature Bank, and First Republic all collapsed in a matter of days. The Federal Reserve had to launch emergency facilities to stop the bleeding. Those problems were never solved, just papered over. Today, hundreds of small and mid-sized banks still sit on massive unrealized losses due to the bond market crash. If depositors lose confidence again, another wave of bank failures could erupt overnight. And this time, there may not be enough rescue funds to go around. Globally, the situation isn't any better. China's property market is imploding, with giants like Evergrande and Country Garden defaulting on billions in debt. Europe is struggling with an energy crisis and stagnation. Emerging markets are being crushed by a strong U.S. dollar and rising borrowing costs. It's a perfect storm. Every major economy is battling its own version of financial stress, and there's no global growth engine left to save the world. In 2008, China's massive stimulus helped pull everyone out of the abyss. This time, China itself is the epicenter of the problem. There's nowhere left to hide. So what happens next? The crash won't be a single event, it will unfold in waves. First, the bond market trembles, triggering margin calls and liquidity shortages. Then, equities start to slide as corporate earnings disappoint and credit spreads widen. Next, the real estate bubble bursts, leading to defaults and banking stress. Finally, confidence in fiat currencies begins to erode, pushing investors toward gold, Bitcoin, and other hard assets. By then, the media will call it the Great Reset, a restructuring of global finance unlike anything in living memory. Governments will step in with massive stimulus and new regulations. Central bank digital currencies BDXE may emerge as the new form of control, marketed as stability but built for surveillance. The average person will feel it through job losses, higher taxes, and disappearing savings. Retirement accounts will shrink, housing prices will fall, and businesses will close. It will be painful, no doubt, but out of this destruction may come transformation. The system that collapses will make room for something new, perhaps fairer, more decentralized, and more transparent. That's why awareness is critical right now. You can't stop the storm, but you can prepare for it. Diversify, hold cash, minimize debt, own hard assets, and stay informed. Don't chase the hype, protect your capital. The people who survived 2008 weren't the ones who panicked, they were the ones who saw the writing on the wall and acted early. The bottom line is simple: the current financial system is built on unsustainable debt, artificial growth, and blind faith in central banks. The next crash won't just be a correction, it'll be a reset. A once-in-a-lifetime event that redefines money, power, and wealth. The question isn't if it happens, it's when. And when it does, it will separate the prepared from the panicked, the informed from the ignorant. We are witnessing the final phase of a 50-year debt supercycle coming to an end. What rises from its ashes will depend on how we respond today. So pay attention, the storm is coming, and this time, it's going to be worse than 2008.